Mark, thanks for joining us today. What kind of data did you get from Americans on the state of their emergency funds heading into 2023?
Good to be with you, Chuck. Yeah, this is a survey that we just conducted and published the results on the state of emergency savings this week at Bankrate.com. And we're finding that the impacts of high and continuing inflation coupled with the interest rate hikes that began in March of last year basically winnowing away Americans' emergency savings. And we know that all too many Americans already live paycheck to paycheck. That is the case for a majority of Americans. We've established that data over many years at Bankrate. And so 49% of American adults say they either have less or no emergency savings compared to a year ago. 39% say they have less than last year. 10% had none a year ago. They still have none. We do have 25% who say their level of savings is about the same, and about 1 in 4 saying that they actually have more savings, emergency savings, than a year ago. So, inflation isn't going away. We see that of late with fresh data releases, and so this is quite concerning.
Mark, do you run this survey every year, or is this something that you just did this year?
No, we've been running something along these lines for about 13 years, and the good news on emergency savings has been, with the other data set that we updated last month, that we had 43% of Americans said that they could pay an emergency expense of $1,000 or more from savings. Now, you might say 43%, that's lousy, but that's actually just 1% below essentially the highest we had ever seen last year, which was 44%. So in the history of us doing these surveys, which is a little over a decade, broadly speaking, we've always had a majority of Americans who did not have emergency savings to pay those emergency expenses or those sudden or unexpected expenses. And the most concerning thing, I think, within this latest findings is that 36% of Americans now tell us that their credit card debt outweighs their emergency savings. That's a record high in the 12 years of asking that question. And as you know, the credit card interest rates are very much related to what the Federal Reserve does, unlike some other financial products out there. And the Fed's signaling that they've got more rate hikes up their collective sleeves, and so that means that the average that we're now seeing for new offers for the best qualified individuals for credit cards, which is hovering just under 20%. That's slated to go higher here in the coming months, and we know then people who have fewer or less robust financial resources, well, they're paying more.
Mark, demographically, are there any age groups that seem to be in better or worse shape at this point, or is it pretty much the same across the board?
No, actually, this is something where those who are earlier in their lifetimes and their financial trajectories and their careers, it makes sense that they have fewer financial resources, less financial resources with which to work. And then the flip side of that is those who are most senior, and that includes, members of the silent generation, those who are at traditional retirement age, which varies obviously for generations or certain cohorts. But let's just say 65 plus and older boomers are in the better positions here. I do think that there is a possible prospect for people to make some progress on this if we see inflation sort of crawl back into its cave, which, we're still waiting for a substantial movement with that. But we have seen recently where wages adjusted for inflation have begun to make some progress, have turned positive. And, every month it's a new adventure with respect to the economic data. We started the year with a stronger showing for the economy than we would have expected. So, fingers crossed that we can make some progress. And the main thing here with respect to call to action is, try to avoid that costly credit card debt if we can. We need to pay our bills too, of course. But the other part is that the savings environment now is the most rewarding we've seen in over a decade, with the rewards on savings or the return on investment, so to speak, being paid at higher yield. So 4% yield, not that hard to find these days, whether it's for a CD or a traditional savings product. The key word there for people is high yield savings, and that's what you want, is high yield and liquidity, or the ability to get that money out in a hurry if you do have that emergency expense.
Very good. Mark, appreciate you joining us today. Thanks so much for the time.
Thank you, Chuck. Great to be with you.
That is Mark Hamrick from Bankrate.